Recorded Books and One-Click Digital present A Random Walk Down Wall Street, the time-tested strategy for successful investing by Burton G. Malkiel. Narrated by George Guidall. Part 1. Stocks and Their Value. Chapter 1. Firm Foundations and Castles in the Air. From Oscar Wilde, Lady Windermere's Fan. What is a cynic? A man who knows the price of everything and the value of nothing. In this book I will take you on a random walk down Wall Street, providing a guided tour of the complex world of finance and practical advice on investment opportunities and strategies. Many people say that the individual investor has scarcely a chance today against Wall Street's professionals. They point to professional investment strategies using complex derivative instruments and high-frequency trading. They read news reports of accounting fraud, mammoth takeovers, and the activities of well-financed hedge funds. This complexity suggests that there is no longer any room for the individual investor in today's markets. Nothing could be further from the truth. You can do as well as the experts, perhaps even better. It was the steady investors who kept their heads when the stock market tanked in March 2009 and then saw the value of their holdings eventually recover and continue to produce attractive returns. And many of the pros lost their shirts in 2008 buying derivative securities they failed to understand, as well as during the early 2000s when they overloaded their portfolios with overpriced tech stocks. This book is a succinct guide for the individual investor. It covers everything from insurance to income taxes. It tells you how to buy life insurance and how to avoid getting ripped off by banks and brokers. It will even tell you what to do about gold and diamonds. But primarily it is a book about common stocks, an investment medium that not only provided generous long-run returns in the past, but also appears to represent good possibilities for the years ahead. The Life Cycle Investment Guide described in Part 4 gives individuals of all age groups specific portfolio recommendations for meeting their financial goals, including advice on how to invest in retirement. What is a random walk? A random walk is one in which future steps or directions cannot be predicted on the basis of past history. When the term is applied to the stock market, it means that short-run changes in stock prices are unpredictable. Investment advisory services, earnings forecasts, and complicated chart patterns are useless. On Wall Street, the term random walk is an obscenity. It is an epithet coined by the academic world and hurled insultingly at the professional soothsayers. Taken to its logical extreme, it means that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts. Now, financial analysts in pinstriped suits do not like being compared to bare-assed apes. They retort that academics are so immersed in equations and Greek symbols, to say nothing of stuffy prose, that they couldn't tell a bull from a bear, even in a china shop. Market professionals arm themselves against the academic onslaught with one of two techniques, called fundamental analysis and technical analysis, which we will examine in Part 2. Academics parry these tactics by obfuscating the random walk theory with three versions: the weak, the semi-strong, and the strong, and by creating their own theory called the new investment technology. This last includes a concept called beta, including smart beta, and I intend to trample on that a bit. By the early 2000s, even some academics had joined the professionals in arguing that the stock market was at least somewhat predictable, after all. Still, as you can see, a tremendous battle is going on, and it's fought with deadly intent because the stakes are tenure for the academics and bonuses for the professionals. That's why I think you'll enjoy this random walk down Wall Street. It has all the ingredients of high drama, including fortunes made and lost and classic arguments about their cause. But before we begin, perhaps I should introduce myself and state my qualifications as guide. I have drawn on three aspects of my background in writing this book. Each provides a different perspective on the stock market. First, is my professional experience.
Sample complete. Ready to continue?